Welcome on back to another Stock Market Open Live. Oh, let's fix that. There we go. There's the audio we know and are used to and love. All right, welcome. So today we are starting with good old Bitcoin, sitting right at 65.6. And it looks like slipping a little bit, just like Tesla stock here sitting at 178. This one just can't come back to life. I don't know what it is. It just seems to just wants to hang out, I guess. While at the same time, Nvidia's up again another percent. It's almost like every single day it's just up a percent. Like at this point, it just seems like it'd be abnormal if Nvidia is not up a percent. Pretty remarkable, but that means now if you split adjust this, you'd be at basically 1330, which is remarkable. So congratulations to those exposed to Nvidia. Well, then again, I'm exposed to Nvidia myself, but the thing keeps going up, and then I keep taking a little bit of the chips off the table. I'm like, oh, all right, that's good. Nope, just wants to keep running. That's okay. So then you've got, what do we have here? Qs are up about 13 basis points. Well, what's really moving this morning here? Let's see here. You've got Autodesk. Up 4.8 here. Broadcom 3.3. Micron's up 2.75. ARM's up again at 161 bucks now. Wow, nice. Yeah, so it really tipped down to 90, and then it was straight up from there. You've got Hewlett Packard, Vertiv, Chipotle, ASML, Super Microcomputer. Basically, all of your classic, typical computing companies, your server rack companies, memory companies, they're all wanting to run today. Okay, fascinating. And then on the flip side, we've got Coinbase, Matterport, Robinhood, Carvana, Redfin, a little bit more on that risk asset side. Tesla. This is very similar to what you had going on Friday. And a lot's really come after the Federal Reserve has really come across as a little more hawkish than people would expect. Yeah, you'd think you'd get a Fed that says they're data dependent. You'd think they'd actually react to the data, but no. Instead, let's just keep the boot on the neck of the small caps. Anyway, that's potentially a continuation of what's going on today, which is somewhat unfortunate. But anyway, bonds right now sitting up about 5 basis points on the 10-year. So a little bit of a surprise as well, since bonds have been falling almost every single day last week. They were falling thanks to just weaker data over and over and over again. But we'll find out how things actually go. So let's see here. We've got some more drama, it looks like, regarding Elon and the SEC potentially beating him up over disclosure or potentially violating disclosure rules so he could acquire more X shares at cheaper pricing on some revised civil lawsuits by the SEC. So it looks like that fight's going to keep going for a little while. And let's see what we got also in terms of caddies this week. This is going to be interesting, so I'll just take a second to pull that up. Then let's see, it's June 17th. Well, it's already June 17th. It's kind of remarkable how quickly the second quarter is just flying away. But that's all right. Let's listen in here for a moment, see what they got for us, since they're talking about Tesla.
Companies can help each other.
Yeah. Tim, thank you for joining us, and it's good to see you out here.
Oh, looks like he's leaving.
Ah, that's right. You're in person.
Here.
You might be an avatar.
Yeah, no, it looks like they're about to pull off this. Yeah, it looks like they were just having the same conversation about the SEC's investigation into Musk. It doesn't look like it's going to go away anytime soon. The SEC is, pretty set in making sure they follow their rules, and then if other people don't follow the rules, they'll make sure everyone's aware of that. But then again, rules are there for for a purpose. But I know Elon does not like the SEC and feels targeted by the SEC. So we shall see. Let me get now catalysts. So we get Empire Manufacturing as of like 2 minutes ago came in at -6 versus the -10 expected. So a tiny little bit better than expected, though that one tends to be very volatile. I don't think the market very much moves off of that. We'll get retail sales tomorrow, actually. So tomorrow morning we'll get retail sales, so that should be fun. Advanced month over month, X auto, X gas. You'll get industrial production. Let's see here. What else? Business inventories. Okay. So we'll get some of these numbers tomorrow. Retail sales are always an interesting one. Just sort of get a little sense of how that consumer's holding up. And on the 19th, which is then Wednesday, we'll get mortgage apps. Thursday, we'll get initial claims again. Had a little bit of a pop last week, so we'll see what happens this week. Housing starts, building permits. And then we will, on the 21st, get PMIs, S&P Manufacturing Services, and Composite, the blend PMIs. So that's really your week in terms of catalysts. You don't really, let's take a peek here. When do you really start with our earnings again in earnest? Let's see. When do we get bank earnings again? Well, let's see. I would guess probably not for another month, really. Because we got to get the second quarter done, which would be the end of June. Yeah, I know you're pretty quiet here for a while. Until, let's see, you got Micron. When's that? June 26th. Alright. Oh, Nike. Okay, Nike, June 27. Boring. Just a lot of an empty calendar here. Bank's got to be second week of July. There it is. JP Morgan's July 12th. So, really, we've got a little while to go here before you get some caddies again. Which is a little boring. But what a window, because that's like 4 weeks away. Ish. Minus, 4 days or whatever. And you don't get another, what's your CPI report? Let's see here. Next CPI is going to be July 11th. 7/11. So on 7/11 day, you'll get CPI. Earnings will start really again on the day after 7/11. And the next Fed meeting, it's not until like the 30th, right? Let's see. Yep, July 31st. So, a little bit of a boring summer calendar, honestly. As far as interest rates, we're now looking at, this thing fluctuates every day, about 1.88 cuts by December, and about 1.1 priced in for November. Let's listen in here for a moment.
In treasuries, with the yields coming down pretty significantly, you've got the 10-year below 4.3%. Do you think the market is anticipating correctly what the Fed's next move is, that the next move will be a rate cut and maybe sooner rather than later?
Well, for one thing for sure, Becky, the market isn't paying too much attention to the dot plot than the change in the dot plot last week. I mean, I don't know. The markets go up, markets go down. They tend to overreact a bit to the latest string of data. So I'm not reading very much more into today's market reaction than I am to the dot plot last week.
We had Neil Kashkari, we heard over the weekend. He said on one of the news programs that he thinks that you will get one rate cut and it could be in December. Does that sound like a likely scenario?
It doesn't seem to be what the chair tried to project at his news conference last Wednesday, Becky. I mean, I thought Jay Powell went out of his way to present as neutrally as possible. He did a good bit of work trying to get people to de-emphasize the dot plot. He emphasized that there had been progress on inflation, but they needed to see more. They needed to be more confident. He talked about the fact that the labor market struck him now as tight but not overheated. So I thought he was doing his best to preserve some optionality for the FOMC and not to project anywhere. I mean, here's one thing to look at, to say, though. If you think there's going to be a September cut, they've got to set that up no later than Jackson Hole. And there are only 2 PCE readings between now and Jackson Hole. And so that means that either the chair and others on the committee need to be putting more emphasis on a cooling of the labor market, maybe moving from tight to strong, as well as a couple of good inflation prints. Or else, if they want more good inflation prints, September is going to be a little hard to pull off. But I think that goes back to the fact that Powell said we look at the totality of the data, which is a way of keeping optionality.
And I guess that's what you want at this point, to wait and really, if you're truly data dependent, you want to see what the next few prints are before you get too far out there?
Absolutely. I mean, look, sometimes in the past, I think it may have been fair to criticize the Fed for not having sort of a narrative and a view of how the economy was performing and what the key factors were. But at this point, after the last couple of years, it's pretty hard not to sympathize with their being more reliant on the past, the incoming data, and less confident about a projection of where things are going. I mean, just about everybody has been surprised multiple times in the past few years. And so I think their position and the chair's position is quite understandable right now.
Where do you think we are?
He's basically just defending the Fed here, suggesting, the data's been all over the place, so let them be patient.
Softer landing, maybe softish landing as opposed to totally soft. But, having said that, I'm going to go back to what I just said a minute ago, which is we all, myself included, have been surprised multiple times. And so, I wouldn't put any more confidence in my projection than in anybody else's.
In terms of the risks that are at play, I mean, you've got central banks in other places, including the ECB, already cutting rates. Does that put additional pressure on the Fed to do the same?
I don't think so, Becky. I mean, the economics of, say, Europe, the Eurozone, and the U.S. are pretty different right now. I mean, we have been quite resilient, I think, more than a lot of people expected. Even with some moderate cooling in the labor market, it's still pretty strong. I think most people are expecting GDP to be rebounding after the first quarter. And so under those circumstances, you face different economic circumstances, you got to have a different monetary policy.
Dan, both political parties are talking about tariffs, ratcheting them up.
The thing is, a lot of people think that the circumstances aren't really that different, that we just measure CPI in a stupid way. And Jerome Powell actually defended the way that we measure CPI last week. And I think he's hearing loud and clear people are like, this is some bull crap, bro.
One perspective on it, that for many years, there was a rough consensus in the middle of both parties for tariff cutting and more trade. And, in all honesty, I think there was a lack of attention to some of the impact a lot of the impact that had on workers and communities throughout the country. And by the way, Becky, I think that lack of attention has fed into some of the political anger on both sides of the political spectrum that is so dominant now. Now we've got so you've got that in the background, and now we've got the additional issue of industrial policy, national security related trade activity. And I think that's why the situation you just described is the one we've got, which is both parties being not so free trade oriented. Obviously, the concern would be if it goes beyond a well thought through way of moderating, massive worker displacement or not protecting national security into a kind of just shutting down trade channels that people may not realize are important for, the kind of goods that all Americans have gotten used to. So I understand the direction that people have gone, and my concern is, is it going to be well thought through? Are people going to keep perspective as opposed to just kind of trying to one up one another? with more trade restrictive proposals.
Okay. Dan Tarullo, thanks for joining us today, Dan.
All right, pretty neutral, fair-headed, seems like reasonable analysis. Okay, so let's do retail. So June 17 retail sales data. I wanted to add that to the list. So we got retail sales data. Jobs data is July 5th, so the day after July 4th. Then you got CPI July 11th, bank earnings July 12th, Fed July 31st. Just want to see if there's anything really else exciting. You do have June. What do we have here? June 28th. You'll have PCE data. That's the Fed's preferred inflation gauge, which will just really be based off these two. We'll have July 2nd, another JOLTS report, job openings and labor turnover survey. Let's see here. FOMC minutes on July 3rd. July 3, Fed minutes. Those have honestly been pretty boring. And PPI July 12. Fine. And PPI, we just had that. It's a pretty dang catalyst-free calendar, honestly. July 30th again, JOLTS. None of this is a big deal. So, interesting from a trading POV, because it's like, you know, generally we like to go into these catalyst events with trading ideas, but lately, following all the catalysts we had last week, it's like, oh, none of these are actually that big of a deal, and the ones last week came in good, but still led to a risk sell-off. I mean, this is what we talked about on Friday, is I go, look, if you want to hedge yourself to the market, you just short Bitcoin. And people are like, what? Why wouldn't you short NASDAQ? I go, well, if I short NASDAQ, it could go up just because NVIDIA's going up. And that's literally what's happening. NVIDIA's going up. A bunch of other stuff is going down. So it's very interesting to chat with somebody about that this weekend. And you know, they suggested, well, you know, it's always possible that other companies or countries could announce they're using Bitcoin, so there's always the potential that you have a positive catalyst like that. It seems like after the ETFs, it's been a little harder to get positive catalysts to actually push Bitcoin, but it's weird. Like once you got the Bitcoin ETF, you're really kind of topped out almost, and we hit that top a couple times, but now sitting at 65.6. As NVIDIA keeps sort of soaring over here. Pretty remarkable. It's almost like you need a downside hedge. You go, I don't know, short BTC. And then you need like an upside hedge. And it's just like YOLO calls on NVIDIA because, it's so ludicrous how, it's run sort of on a daily basis. That's like, all right, join the party. It's the next GME. Who knows? I mean, you could have a blow off the top rally at some point where it just goes nuts. So far it just keeps chugging along. All right, let's give the doomers a shot here. Someone says, "How do you short BTC?" Yeah, I mean, you don't have to copy me in the sense of like it's not personalized advice. Don't. But if you wanted to, the vehicle that I was using was BITI. It's a 1x short Bitcoin ETF. How do I get this? There we go. All right. Did I get Doomers in? Why is this like this? This is boring. Just give me Doomberg, would you? Oh, there it is. Boom. That's what I wanted. Play. Why DirecTV. I don't want all. What is all this crap? Just play the frickin' TV. I want your dumb survey. Go away. Just play what the doomers are saying, so I could see. Give me something to be excited about. Whether it's up or down, I need some enthusiasm. There we go. I think I figured it out. Yes, it's nothing like the doomers. They'll do it for us.
About yields going lower in the face of disinflation, as well as the U.S. just being a haven for a lot of dollars. Lydia, at what point do lower yields boost the economy, boost the economic activity in the United States, and have a self-reinforcing cycle versus indicate some weakness that actually would be negative for the growth prospects?
Yeah, I mean, when we look at the economy today, we're looking at an economic slowdown underway. We've seen some rebalancing in the labor market, some softening in labor market indicators. We're looking at consumers being more cautious with their spending, investments also softening, and companies being more discerning with their spending and hiring because of this tighter credit condition environment, and because consumer demand has softened and consumers are more price sensitive. So in this economic environment, with signs of softening in the labor market, we're expecting to see that recalibration in monetary policy happening, towards, September. We're expecting the first rate cut in September, and rates starting to gradually move lower and move away from that restrictive policy stance. And, by, seeing that those rates moving lower, we should, ensure that the economy doesn't slow down materially. We're expecting to see growth falling below trend in the coming quarters, but we're not expecting to see a retrenchment in economic activity. And the fact that the Fed is going to embark on that easing cycle should allow for that cycle to continue and run through 2025.
Stephen, what's your view on this? Because some people would say that this economy has been a lot less sensitive to rate hikes. Why would they be so sensitive to rate cuts?
Yeah, that's a fair point. So you have to be careful with this one, because I think that people...
He looks like he's reporting from prison or something.
So in fact, that's all conditioned.
It's like one light above his head. That's all you got.
So I find a bit of an echo chamber around the mainstream forecasts, because they're all basically one standard deviation from the Fed. It strikes me that it's probably true that the economy isn't that sensitive to the rate cuts, but when the rate cuts come, I think they're probably going to be more than the market's pricing in, and that's exactly the point. That cutting by 25 basis points here or there isn't going to do anything. So when the economy is really cooling, and if unemployment is going up at a faster rate than the Fed's forecast, I think that could be a kind of scenario to think about. Then rates will be cut quite hard and fast. Also, Lisa, it's not just about the U.S. cyclical economic data. It's about the structural factors, this huge stock of debt. It's about what's happening in China and Europe, and ultimately, U.S. rates just look out of line with everything else.
Stephen Major of HSBC, Lydia Bassour of EY. Both.
All right. Yeah, it looks like an interrogation, right? Exactly. It's an interesting point, though. It's basically arguing that, oh, just wait. Once they cut, they're going to be cutting. They're going to be cutting good. Even Grant Cardone will be happy. But take a look at this. What do we... Oh. What? How did I lose that camera? Yeah. There we go. Much better. All right. So... There we go. That's what happens when I start making changes in the studio. Sorry, I was upgrading something. A little new feature. I got another monitor, basically. Another iPad. It's going to be a soundboard soon. It's going to be really cool. Alright. So, it's because I got some custom sounds made. Bet you can't wait to hear my custom sounds. So this is interesting. This is by some Nick dude, not to be confused with Nick T over at Morgan Stanley. He's basically like, hey, look, AI themes and GLP-1s are doing great. And they've remained sort of a tailwind to markets. But there's still some risks, and these are the ones that people are paying attention to. Major elections, stagflation, and some potential other issues with the, quote, flip-flopping macro narrative we've seen recently. Hey, who are you quoting? This week's softer U.S. inflation data helped drive conviction in disinflationary traction. Can't feel like the largest risk for the market is not upside in an inflation, but downside in growth. So that's sort of his argument that maybe some form of plummet in growth is going to be what punches this economy in the face, especially just pricing in one Fed rate cut. So this is really a way of saying, it's kind of scary, but it's a way of saying, what if you have what if super slow, snail-paced slowing of jobs market and econ? So basically, like a really, really slow slowdown, and basically a with the Fed that's moving like a snail too. So that would be this like slow burn of the economy. It would be really kind of the most frustrating. There wouldn't be sort of this one catalyst. It's not like there would be this big bang of bank collapse or whatever. It's just this slow, frustrating bleed. That's possible. Let's see. Major indices as buoyant as they've ever been. Some investors may wonder why the Fed would really cut with stocks at all-time highs. They've done it 20 times since 1980, and the SPY or the S&P was higher. Let's see here. Hold on. All 20 times. That's cool. Could the Fed really cut when stocks are at all-time highs? Yes, they've done it 20 times since 1980, and the S&P 500 was higher a year later, all 20 times. Bulls will be putting their faith in history, while bears might argue we'll only see this magnitude of cuts if something is broken. Right. And that's, obviously the black swan argument. Like all of a sudden, something just, at first, nothing, or very slow, and then all of a sudden, everything. All right, interesting. I still don't understand. Tesla's down like 80 basis points right now. And Nvidia's up 1%. Yeah. Also having trouble hearing out of my left ear. Too much pool water in there. Went swimming with the little boys. Good old Jack and Max. Let's see here. Notably, but not surprising, Nvidia accounts for 34% of the S&P 500's 14% year-to-date gain. Wow. That's crazy. I didn't think of it that way. Nvidia accounts for a third of the S&P 500's gain this year. That's crazy. What? Look at this one. Over the last 2 years, here. The 6 mega caps with $1 trillion market caps are up an average of 11.2 or 11.5% in the second quarter. The remaining 490 stocks are down an average of 3% in Q2. Holy crap. Yeah, that's... I'm sure it's sustainable. After all, Nvidia's... this is the revolution of our lifetime. Folks, if you want to see the revolution of your lifetime, make sure to ask GPT all the questions you have. Alright. AI remains on track as shown by Apple, introducing Apple Intelligence in partnership with OpenAI. Stock's nearly up 30% since then. I'm just surprised it's not going anymore. I thought Apple would have moved more on this. It's up 53 bips today, but still. In fact, I have that right here. I was a little disappointed that when you do when you make these drawings to calculate stuff. For example, let's do 69,000 times, I don't know, 40%. Is it actually gonna work? Oh, okay, now it's not gonna work. Maybe not. All right, let me try. Basically, my experience with it was this little calculator thing that Apple was doing wasn't like, is that great? And then it turns into a picture afterwards if you want to pull it up on another device, which is also kind of lame, because like if I wanted to prep it, and then all of a sudden I go to another device, it just turns into a picture. Yeah, I can't even get it to show calculator right now. But if I'll go to the last one that I did. Yeah. So, new handwritten note. So, like, this was the last one. I was playing with Jack with this. And it was kind of neat because we were able to just change one of the numbers. We'd go in and change, the 7 to 70 or whatever. And then it would kind of recalculate, which was kind of cool. Oh, there we go. Oh, yeah, it still functions. So let's write in, how about I write in, I don't know, 5. Yeah. See, that's kind of cool. I noticed that in other devices that don't yet have the update, which makes sense. It just shows up as a picture. But it does actually let you go back and edit it. It's just sometimes getting it to actually pull the little calculator module up seems not the smoothest just yet, but it could just be early. So, but I'm going to put in a 0 there. Yeah, that's not bad. 501. Ooh. Kind of neat. I don't know if it's how useful that'll end up being, but we'll see. So, let's go back. Where were we? Right here. Okay. Earnings growth, let's see here. Strong guidance from Broadcom and Oracle were further proof that some companies will not just see multiple expansion, but will also see earnings growth as the theme matures, as well as Adobe. Robust earnings and revised guidance. Consumer earnings this week reaffirmed the theme of a more selective consumer. Dave & Buster's, Academy Sports, or any indication. Yeah, Dave & Buster's just been bleeding since their earnings. Weak guidance from Restoration Hardware that consumers continue to defer high-ticket items, blah-de-blah-de-blah-de. That's not great for, like, an end phase. Or typically car manufacturers as well. Although I think that low interest rate offer is really exciting for Tesla and should be good for earnings. You do have the... let's see here. Tesla deliveries will probably be that first Monday. You'll probably be looking at July 1 or 2. Somewhere around there. I would guess July 1. Tesla. Sorry, wait a sec. Q2. Yeah, that should be July 1 or 2. And, okay. Mike Wilson. Some commentary here about him. Okay. Let's see. What does he say about Mike Wilson? Mike Wilson notes the S&P 500's trailing 12-month earnings growth is turning higher, now 4%. Margin improvement is fueling this increase in earnings. Yeah, margin improvement is one of the reasons people think there might be a jobless recession, just because how do you keep improving margin? We just keep firing people is what some folks thought. And I'm like, oh, that sounds harsh. Crazy market. Diving further into elections. Outcome uncertainty to persist for U.S. elections. Yeah, we've kind of looked into what elections do for markets anyway. Usually it's up. All right. Interesting. I don't know. But it seems like some enthusiasm. At least for AI. Not necessarily in that concentration, though, in the S&P 500. Boy, oh boy. That's wild. All right. Let's jump for a moment. See if CNBC has anything entertaining for us.
But anybody trying to beat it or keep up with it. And I think that's the source of unease in this market is, the average stock out there has been languishing relative to the S&P. Does that tell us something about the economic outlook and what is being discounted, or is it just AI momentum kind of consuming all the fuel?
Well, if you read some of these reports, Goldman Sachs, let's hit that one because David Costa, and he'll be on this week to talk about it, but he didn't change his earnings expectations overall for the market. 2024, 2025 unchanged, but stellar earnings growth by 5 mega cap tech stocks have offset the typical pattern of negative revisions to consensus EPS. They didn't change their outlook for real yields either.
Exactly.
It wasn't like a call on, we're going to view the market better now necessarily. It's that what's happening with big cap tech and how that's influencing the earnings picture.
Exactly. And it's giving higher conviction of the achievability of the index earnings because it is in these small number of names that seem to have tremendous earnings momentum. David Costin also kind of resorts to, what if you look at the equal-weighted S&P 500 and look at how the valuation there is more modest? That is true, but it's still just taking the outsized profits of the, let's say, top 8 or 10 growth stocks and spreading them across the entire index. I mean, the earnings are still there, even if you dice up the index separately. And so the median forward PE on the S&P 500 is probably 19 plus. It's not 16 like the equal weight says. My point is, you can't get away from the idea that the way this market plays defense is by buying the most high conviction names, the highest quality names, the largest names, the ones with the best earnings momentum, and they're all the same stocks. Everything I just described is like 8 or 10 stocks in the market right now.
This was the subject of B of A's note last week, where Savita talked about the fact that we all sort of have shock from COVID, shock from the GFC, big piece in Barron's over the weekend about Gen Z and their risk tolerance. And as a result, you wind up in maybe the most aggressive growth names, right? Secular growth names.
And it is really interesting because semis in particular look super overheated. The flows into the ETFs has been massive. There's a lot of just like upside stampedes in NVIDIA and some of the related stocks. And that would make you say, wow, the public's getting a little bit overexcited here about the stocks, but they're not getting overexcited about stocks. They're getting overexcited about those stocks. And you see penny stock volumes start to go up because you have the lottery ticket players involved. But then you have everything else kind of sitting out there. Now, here's the thing.
I see someone's comment. Okay, maybe that's why. So you just have to write the equal. As soon as it sees the equal, then it'll do it. No, see, that's kind of cool. Yeah, that's not bad. So, and then I could go in here and kind of doink with this a little bit. So if I'm going to go change that to, let's go with, we want Bitcoin to go up 80%. That would look like 124,000. Yeah, that's not bad. That's nice little visual, especially teaching kids math. That'll be kind of fun.
With the market that people still complain about the fact that it's poor breadth. We just talked about all the action is in the mega cap. Volumes have been pretty low as well. Yeah. People are paying attention to, and there are some signs. Okay, defensives aren't working that well. You know what else hasn't been working well? People are noticing is the transports.
That's right.
Cyclically tied in stocks to the economy that have really started to underperform, leading to questions about whether we are in for a bigger growth scare. That's something I'm monitoring.
I think that absolutely has the market's attention. So transports have been actually a laggard for a while, for several months. But it shows you that this isn't really an economic momentum market or even a broad equity momentum market. It's just kind of a grind that's kind of digesting loose financial conditions and really strong secular AI trends and not much else.
To Sarah's point about cyclical...
Yeah, that's kind of a good way to put it. Secular AI trends, loose financial conditions, and then high rates.
That notion of the economy slowing is something that Neil Kashkari did address on CBS over the weekend. Take a listen.
We need to see more evidence to convince us that inflation is well on our way back down to 2%. We're in a very good position right now to take our time, get more inflation data, get more data on the economy, on the labor market, before we have to make any decisions. So we're in a strong position. But if you just said there's going to be one cut, which is what the median indicated, that would likely be toward the end of the year.
Yeah, he did say one would be a reasonable assumption.
He's also on the hawkish end now of the Fed. Hard to keep track. He's been on both sides. But now, yes. And the fact that he's talking about one cut by December, I don't think is surprising at all. Look, it's about the data as much as it is about the Fed rhetoric. And I know we're going to get a lot of Fed speakers this week. But actually, what might be more important is the retail sales number that we're going to get on Tuesday. Because last week, the Fed put out in the median one cut for the week, and the week ended with Fed funds futures pricing in two cuts because the inflation data mattered more,
absolutely,
I would argue, than the Fed. Weaker CPI, weaker PPI, weaker indications on import prices and other factors. And that is what's leading the Fed ultimately. So retail sales will be interesting because last month they were disappointing. They grew 0%. They are set to rise 0.3%. Strong consumer could put more pricing pressure on for the Fed. Indications are that it actually should have rebounded in May. Consumer spending. We look at sort of data like Bank of America's credit card numbers and that sort of thing. So I think how they're going to tackle the growth issue right now is almost as important. Well, not as important as inflation, but it is.
Somebody here writes, Apple integration will make OpenAI use a lot of NVIDIA chips. That will be at least $100 billion in revenue for NVIDIA. Where do people come up with this stuff? So some more queries through Siri to GPT is supposed to somehow translate to not using the existing GPU infrastructure that exists, which seems readily available, but it's supposed to somehow translate to another 100 billion. Yes, another 100 billion in revenue. If these are the people buying NVIDIA, I'm scared.
Meanwhile, lurking in the corners is the labor market, and Morgan Stanley's Ellen Zentner late Friday did have a note. Risks to employment growth have risen. She's looking at continuing claims year on year. Obviously, we had initial claims up 3 straight weeks. Even with the last NFP print, more discussion about the SOM rule and what happens when you're up 0.6 on unemployment from the cycle low, things like that.
Right. Jobless claims, I think it mattered last week, where we saw the most Americans filing unemployment claims since, 2023, but in several months. It was a notable move up. And look, you've had the 10-year yield lower for the last 10 of the last 12 trading days. That's been the trend, buying bonds. And it's reversing a little bit today. But as long as we continue to get inflation numbers that are either consensus or a little bit below, potentially more weakness in the jobs numbers. And even Powell himself sort of dismissed the last hot unemployment report where we got a really big jump in non-farm payrolls, but then a weaker move on the household survey. He said that even that looks a little overstated. People are passing around a lot of charts about how much the labor force has grown in the last few years. Non-Native Americans. Native American labor force has been unchanged in the last few years. So people are using a lot of those charts and adding it up to say, okay.
Look at Chipotle's move, by the way. It just kind of keeps pushing here. Jeez. It's now at 33.25.
The Fed really fixates on unemployment rate, even though they're looking at the monthly payroll numbers from the different survey, the business survey. They're predicting 4% the year end in the unemployment rate. That's where we are, and so you have to be attentive to those dynamics. I do think that's where the market is. It was always going to be, wading through an ambiguous set of numbers on the way, even if we get a perfect soft landing. So it's always going to look like slowing too much or inflation's not cooperative enough, and that's what we've been all year. Meantime, if you own the index, you've been fine because it's been really animated by other things.
Couple things on the big tech dominance that you mentioned, Mike. One is that Costin does address it in this move up to 5,600. The other is that Citi closes their positive catalyst watches on both Apple and NVIDIA. We've gotten WWDC under our belts, got the split of NVIDIA and Computex under our belts. now what?
Ex-
Isn't that the concern?
Well, that's definitely the concern, or at least that's the takeaway of, okay, we got what we thought we might get in a best case scenario. Apple back up to 30 times forward earnings. The earnings estimates haven't started to move on whatever new order cycle might be helped by AI. That might happen, but at this point, it shows you that it's kind of fully valued on its own terms, and that Nvidia,
This is interesting. I'm gonna let's take a look at this. Somebody sent this over to me, or tagged me in it at least. McDonald's is removing its current AI technology from more than 100 drive-thrus. McDonald's boasts over 27,000 drive-thru locations. To further expand its drive-thru dominance, the fast food giant entered into a partnership with IBM 3 years ago, making over 100 select McDonald's drive-thru lanes experimental grounds for testing automated order taking. Apparently, these have led to some, at least, frustration from customers. Although it did seem like the AI order systems were useful at getting people to buy more stuff. Though part of me wonders if there's like a novelty of, like, oh, this is cool, it's automated or whatever. Sure, I'll opt into your upsell or whatever. Like, I feel like there's a little more looseness when people first experience a new technology. It's just kind of like a cool thing. But anyway, I guess they're now canning this. I don't know how much of this was the old, like, it has to do with new AI though, because it looks like they started supplying some of these in 2021. Yeah, looks like they're getting rid of all of them by July 26th. This is interesting. It's going to explore a different option rather than the IBM version. I mean, who knows? That could be potentially the old school AI stuff rather than, like, you put like GPT in the lane. I'm sure it'd be decently functional. Anyway.
Tremendous. HPE has been in there. Supermicro has been one of the best performing stocks of the S&P 500. And then what?
Yeah.
And I think that's sort of one thing that we want to talk about with Michael Dell. How much of his company is going to be transformed by AI, and is it going to be profitable? Remember, there were some questions about that after last earnings when the stock dropped almost 20% on earnings because the margins missed.
There is a huge debate that's developing about just who's going to be entitled to this massive profit pool, what points along the food chain. So yeah, kind of the installers, the resellers, and then software, because that's been sort of left out in the cold largely, meaning non-NVIDIA software.
Yeah. It's a good day for Dell, at least to have him on. Morgan Stanley reiterates the top pick on that name as well. When we come back, Boeing once again in the Capitol Hill crosshairs when it comes to the company's safety issues. We'll get to Disney, got some news on Autodesk, calls on Best Buy and Stellantis as futures are split. Stay with us.
Well, yeah, about 15 minutes until Zibel. Let's go see what else there is. So that was an interesting Morgan Stanley note we got to go through. Let's see what else there is. Let's see here. 15-year study on catalysts, eh? This here's just a 15-year study on reactive ETFs. That's fine. So yeah, this is an interesting phrase. I'll show this here. It says here, past moves on macro catalysts are useful for predicting future moves, but the importance of the events change over time. Many have documented the alpha during FOMC meetings. However, FOMC meetings have become less consistent for moving stocks in a certain direction. So they're basically suggesting the market cares about different things at different times. So maybe the market just cares less about CPI and PPI, for example, at this point, than it did a couple of years ago. Fascinating. That's not a surprise. Okay, right now it seems like the market only cares about Nvidia split. Nvidia go up. Yes. There's no more logic required. HSBC calls for a one and done with a hawkish hold. Okay. Very boring. We need some drama. Some entertainment. Oh, what's this? Has the first monetary canary croaked? Ooh. See, this sounds bearish and therefore shocking. Let's take a peek. Since the start of the tightening cycle, investors have been wondering which economy would be the first to break. This is why I drew up a list of monetary canaries, countries that seemed most vulnerable to higher interest rates. Oh, is this going to be about France? Typically because private debt levels were higher because they had a lot of short-term liabilities. Higher rates are dangerous when they cause distress amongst borrowers. This happens in countries with a lot of debt. My monetary canaries include Canada, Sweden, Norway, Australia, New Zealand, and some Euro sectors. French corporates in the UK. Got it. I thought Canada would be the first to go, but the Canadians have so far avoided this. Okay. So who's croaking? Canada still looks dodgy right now, but my focus has switched to the UK. The UK is interesting because it allows a lot of exposure to variable rate debt. Even many of the quote-unquote fixed-rate mortgages roll over within 2 to 3 years. But that is not the main thing that interests me about the UK. The UK has seen a rebalancing in its labor market that may have gone too far. Post-COVID normalization is turning to genuine weakness. There's a potential warning about what may be happening elsewhere. What do they mean? Let's see here. 2 years ago, the UK had labor shortages so acute as the US. Today, those shortages are gone. One of the most important questions in macro is figuring out what has driven the labor market rebalancing. Was it demand destruction via monetary policy, or was it the result of demand normalization? Normalization should end when things have normalized, obviously. But demand destruction continues until central banks reverse course. My worry about the UK is that we are now beyond normalization, which means policy is too tight. In fact, as labor shortages diminish and margins decline, a genuine recessionary dynamic can take over. People actually lose their jobs, which triggers a plunge in confidence and further job loss. We've already kind of seen some of the numbers come in a little warmer in America even for job losses and declines in confidence, like what we saw on Friday. Until recently, the UK was on a path to a soft landing. Now unemployment is starting to increase, and we're moving outwards. Okay. UK labor data are a bit messy. Like the US, households and payrolls. There's been a divergence. In the UK, payrolls are now starting to crack. Uh-oh. The BOE seems in danger of pivoting too late by allowing employment to decline. If I'm correct, the Bank of England will need to take action quickly, abandoning its obsession with lagging wage data. Remember, the UK labor market is more flexible than many others, particularly those in Europe. The ECB can afford to dither without risking a deep recession, but the Bank of England doesn't have that luxury. Perhaps the first canary is about to croak. Yikes. That's it. Wow. Yeah, that's a classic sort of jobs recession argument. That's a big one right now. Well, the economy, once it starts rolling, it can be somewhat self-fulfilling. It's just a little scary. Now, once some people lose their jobs, a lot more people lose their jobs. It's like the velocity of money in a bad way. It's the velocity of job cuts.
What we're
Bad.
seeing happening in elections is definitely amplifying it. We might see a number of different economies moving in the same direction in terms of that pull towards the right, but it's happening in different ways and at different times over the course of, I think, will continue to evolve this year. So that adds to the divergences, but this could be very short-lived in nature. We could see that the result of the French elections winds up being something similar to a Georgia Maloney kind of event, where we have a more centrist party, and there really wasn't cause for the kind of concerns that many investors had. We'll see, but I do think that primarily for me, the divergences are around the economy and the monetary policy reaction.
In terms of policy, you know, it used to be when I was a kid that the right wing, at least in this country, believed in free markets, right? Open border, trade, and now nobody buys that. It's all about protectionist tariffs and, you know, attracting businesses. The Biden administration has put out a ton of money to attract businesses to manufacture here in the U.S., so much so that Europe is very angry about it. Does that continue no matter who gets elected?
I suspect it will in the shorter term. I mean, what we saw in 2023 was pretty amazing. 70% of the industrial policies were created by developed economies. And in fact, if you look at the big economies, the majors, the US, the European Union, and China, they were responsible for 48% of industrial policies. That's unusual.
It's interesting. The Qs right now, they're only up about 2 basis points. You do have Tesla trying to recover a little bit. Bitcoin as well, a little bit of a recovery here. Apple's still at 50 basis points, so that's pretty stable. And then Nvidia up about 1.37-ish here. Enphase down about 0.5%. Autodesk 4.5. Nice. All right, keep listening here.
And then later, Sarah Hunt of Alpine Saxon Woods joins us on tech's momentum and whether it still has room to run. This is Bloomberg.
Boring. Boring.
Constructive input from them. We'll talk more about that in a little bit. Get the opening bell in about 6 minutes. And don't forget, you can catch us anytime, anywhere. Just listen to and follow the Squawk on the Street Opening Bell podcast.
All right. Also quite boring. Fine then. Fine. So, let's see here. What are we going to get today? I don't know. Yeah. I think we're looking for some form of market news. I don't think we have that just yet. Right. Okay. So, who's going to win the election? What does everybody think? I feel like that's more entertaining to talk about right now. Stock market's just being boring. Who's it going to be? What does everybody think here? Wow. Or not a lot of Biden votes there. I see a few of them there. I see they're in there. We'll do a poll. Let's run a poll here. So, well, let's see here. Let's actually run the poll. And then we will see what people think. Yeah, I found a lot of, even folks who are Democrats feel convinced Trump's going to win. So let me just run that quickly. Start a poll. Assuming a fair election, who will win the election? Trump, Biden. Okay. Alright. I ran the poll. See what everyone says here. Now people can vote in privacy. Yeah, and I'm just running the poll between those two for now. It's in the history of America, we haven't seen, fortunately, an independent candidate win. It'd be nice to have some more options, but that's not the environment that we're in, I suppose. All right, so we'll see what that poll comes back in with. In the meantime, let's see here. Biggest drama today is around that Wall Street Journal piece documenting or sort of outlining the Elon Musk SEC issue. A lot of concern about whether Elon purposefully skirted rules to acquire more of X stock or Twitter stock at the time. But that case has been going on for a while. I'm trying to get Musk to testify since like last year, I feel like. It's been like a year of trying to get him to testify. That article is right here. Elon Musk and the SEC are on a collision course again. It all has to do with the SEC has said in court papers that is investigating whether Musk committed civil fraud by delaying his disclosure or potentially misleading the market about his plans. Anyway. It's just, this has been going on for quite a while. Regulators could potentially raise a fraud claim to claim that Musk intended to deceive the market. It's a little bit more complicated than if he just flat out lied. We just don't have that in this case, but we do have something similar and almost as good, says a securities law expert. Yeah. All right, about 30 seconds away from the bell. So let's go ahead and take a look here at the poll. Oh, wow. Out of 1,453 votes, I'm just going to pause the poll there. 1,453 votes, 81% of you think Trump is going to win. That means there are definitely some on the left who also think that Trump is going to win. That's consistent with what I see, too, in terms of people's opinions.
With the SEC, so there's history.
We're going to keep an eye on it today. Bell and the CNBC Real-Time Exchange with the big board, Catholic Charities of New York and the Archbishop of New York, Timothy Cardinal Dolan at the NASDAQ. It's Kanjun, China's largest online recruitment platform. As once again, Mike, we sort of eye this split between the S&P and the Russell.
Yeah.
That ratio now, a new cycle high for the S&P.
I mean, it really has put a tremendous amount of air underneath that ratio. The bad news is that, you know, it suggests that there's very slim pickings in terms of the stocks that are working.
Okay. Very interesting. I just saw Tesla for a moment there starting to rally up to 178.38. There you go. It's trying to come back to that. So, at the same time, I'm seeing NVIDIA with a big fat red candlestick at the open there. The first 15 minutes are always kooky dooky. ARM, Apple's got a nice little rally trying to come in. Seems like there's some enthusiasm here broadly. Yeah, Super Micro, except for Enphase. Enphase is just gonna go down. Sorry. Okay. And Chipotle's up 2%. Because that one's just like, who shorts Chipotle? I don't know, but it just keeps going up. Yeah, see, look at this bizarre activity with Tesla. It's like you get this rally and then it comes right back down. And really rapidly, too. Like, that was crazy. You could have in either of those first 2-minute candles there, basically, or first 2 1-minute candles, tried to buy calls on Tesla, and then they would U-turn, and now they go up again. It's crazy. The volatility is just insane. It's like, what direction does it want to go? Nobody knows. Well, there goes NVIDIA and the Qs. BTC is slipping, and Apple wants to run. Wow. GME wants to run. Or not. I don't know. Bizarro market. Autodesk rotating down a little. Okay, let me see larger movers. So, largest downside mover that I'm watching is, not much. AMD down 2.3, Coinbase down 2, Ubiquity's down 1.6. You've got, on the upside here, Dell's up a couple percent. Autodesk's up 3. Huh. Let's listen in here for a moment.
And are there governance issues so that investors were misled ultimately about voting the slate? You know, and this was all disclosed again in April. There were questions about whether the company knew as early as March, because that's when they filed with the SEC that they're going to look into this accounting. Here's the letter that Starboard writes to shareholders today. Despite our belief in the strong long-term prospects of Autodesk, we have significant concerns with the company's operations, governance, oversight, and accountability to shareholders, given its lengthy history of missed commitments and underperformance from an operational and financial perspective. I did speak with Jeff Smith this morning, guys, and he said, look, it's a great company. That they have a lot of experience, Starboard, in Splunk and Salesforce and GoDaddy, kind of others in this group, and improving the operations and the margins, which is clearly an issue here. They also need to work on some of the governance issues as well. So, speaking of Delaware, we were talking about it with Tesla. Now Starboard is asking a Delaware court to postpone that meeting and reopen the slate so that either Starboard or others can nominate new directors. Autodesk also gave a statement to CNBC.com saying their board and management maintain an open dialogue with shareholders, welcome constructive input from them. We are confident in our strategic direction, significant margin opportunity, and corporate governance. Clearly, Starboard disagrees with that, and
interesting that the stock is getting a little.
Wow, Apple was running there and literally U-turned completely. It is so weird, just how this market behaves. Let's look at Adobe as well. Yeah, look at it. What the heck? Adobe just fell off a cliff. What is going on? And then how's Autodesk doing? It was up like 3 or 4%. It's also somewhat falling. It's crazy. Weird.
Usage-based, subscription-based. So I think it's interesting that we'll see kind of what the true underlying longer-term earnings power might have been here, and see if they get to any answers.
Yeah, but clearly Starboard wants to hold their feet to the fire, both on the governance front and on the operations front.
Sure.
You know, they were probably looking at it before all of these sort of governance and accounting issues came up.
Because it had been such an underperformer.
Underperforming some of the peers' potential for margin improvement in a growth business. I mean, the company has still grown, and we've.
Yeah, Adobe reported great numbers though. So what's weird is it going down, right?
Revenues. They have a plan for AI and all of that, but clearly going to be under some pressure here with Starboard.
Yeah, although some of those subscription products, Adobe's a good example, have sort of been through the mill in terms of questioning the business model. Of course, that got answered a little bit on Adobe's earnings last week. It's interesting, too, I don't want to call it a trend of activism, but we did have Peltz Disney. You've had Elliott Love. Yeah. And now this. Speaking of Disney, Inside Out 2, we've been looking for something to rescue North American box office, and this is the best opening weekend since Barbie, second best animated opening since The Incredibles 2 back in 2018.
Did you guys see Inside Out, the first one?
No.
Okay, I could have told you that this was going to do well.
Oh, I could have too.
That movie is genius. My kids don't like any movies. They only want to watch sports, except for Inside Out. And they're dying to see Inside Out too. We didn't have a chance to take them, but I know if that's my story, a lot of other parents. And it's also one that the parents love too. I know they say that about a lot of the kids' movies now, but this one really is. I don't know if they won any awards, but they should have when it first came out because it was an incredible, imaginative.
Boring. Here's Tesla. Kind of watching Tesla try to create some form of a red candle here. Otherwise, it's sitting at about 181. It kind of keeps breaking higher on. So you haven't actually gotten a full red. Oh, there you had your first 1 minute red candle. Let's see if that's gonna be your top for the moment. Yeah, had a little rally there. Autodesk wants to come back up. So does Adobe. First 15 minutes are like the weirdest. You're flat on the Qs. Nvidia's coming right back. And Tesla's trying to figure it out. Okay, all right. Fair. Let's see. Doomers.
That they're making in the future, and that's why it could have a very long tail. But I also see the point of saying right now you're seeing the big gains in the companies that are in the early parts of it, because those are the companies that are getting paid right now for AI chips.
Does it matter if we get rate cuts, Sarah? I mean, in order for the bullish case to play out, do you have to have the Fed play along?
Is Inside Out? Is that a 3D movie? So Lauren said we were supposed to go watch some 3D movie on Saturday, but we ended up having like a surprise commitment that came out of nowhere popping up Saturday, so we didn't get to go. So we did a pool party with them instead on Sunday. But yeah, there was some movie Lauren wanted to watch. I don't even ask. She's just like, "Oh, we're going to a 3D movie." All right. Whatever you say.
From all this,
that's probably it.
The rate story is what is important to them.
In terms of the tech sector now versus, Y2K, and people are making that comparison a lot, right? Because valuations have shot up here to 20 plus over the past only 150 days, and the same thing happened previously. Is there a difference in that these companies are actually making money, Sarah? Because, during the 1999-2000 boom, it seemed like driving revenue higher was the only important aspect, and there was no focus on profits.
I think that's a big differentiation, and I think that's one of the reasons that people are less worried about the valuations here as they were in that time frame. You also saw in that time frame a lot of large companies that were selling equipment, financing their own customers. And right now you have a very different situation, because the biggest buyers of some of these chips and servers are the largest companies that have a lot of cash. There's no need for companies to borrow to buy AI chips, for example. So I think it's a very different drop, and you have a much bigger, more concentrated tech picture and a much more concentrated customer base. And while there is some risk in that, it's certainly the best customer base to have right now, because it's a base that has an enormous amount of cash.
Yeah, they're not interest rate sensitive. Totally makes sense.
Are you talking about other businesses like B2B commerce, or do you mean consumers still have enough cash and are willing to spend it?
I think for the current AI boom in the chip space and in the server space, the companies that are buying things like Google and Meta and Amazon all have enough money to have a large CapEx program to start putting some of this stuff into place. And back in the 2000s, you had a lot of companies that were financing their own customers because the customers wanted to deploy switches and they wanted to deploy dark fiber, but they didn't necessarily have the revenues that were commensurate with their needs. And I think right now you see that. And I think on the Apple side, you've seen a little bit of consumer enthusiasm for the changes that Apple is going to bring. So I think, AI has been a part of the consumer technology world for a while. It's just the large language models that have made it much more approachable and or much more able for people to understand what's going on there. So I think that there's a willingness for people to spend on technology. There's certainly a willingness for the large tech companies to deploy capital in specs to continue to add to their capabilities. So I think that that's a little bit of a difference from the last cycle.
Right. I just, I can understand that, companies are waiting in line to get their hands on as many chips as they can. They want to have space at server farms, et cetera. But I just wonder about the strength of the consumer. UBS, I was just saying this morning, upgraded Best Buy because they expect droves of consumers to go in, or at least online, and upgrade PCs to AI capable. We've seen this, with Dell and others. But does the U.S. consumer really have enough money to participate in this upgrade cycle? We have worked our savings down to zero, and you no longer have the stimmies that you had during the COVID.
The stimmies.
Can we still buy as much stuff as Wall Street needs us to?
Well, I think there's been a lot of discussion about the bifurcated consumer and the fact that on the low end, you're seeing a lot more pressure. You're seeing a lot more pressure for folks that have not kept up necessarily with wage growth as everybody else has. And on the high-end consumer, you're seeing a very high propensity to spend. So I think on that technology side, and certainly the way certain things like your phones are no longer subsidized by the carriers, but at the same time, they've made payment plans. So I think that people do have an urge to get the latest and greatest, and they don't want to be left out. I think there is a propensity for that consumer to continue to spend, even though the savings isn't as strong as it was. And I think to the extent that you had a huge...
Oh, yeah, new type. Yeah, be careful with nuclear. There's so many of these companies that are just like startups that have ideas and visions of what to do. And it's all individual company dependent. I mean, I suppose you could try to invest in the whole sector, but I've seen a lot of companies where I'm like, ugh, it's an interesting nuclear idea, but it could also blow up your portfolio. So, as with any investment, it's all in the individual company. Yeah, Tesla's interesting here. Like, look at this. You had this like explosion out of the gate, and it's just right back down to that 179.67, and it's really getting like range stuck here. So we'll see which way that goes. Autodesk went back up to 4%. So weird first 10-minute sell down recovery. Same thing happened on Apple. And it seems like the same thing's trying to happen here on Tesla. You get a little sell down and pop up again. Let's see if that can hold. BTC's barely bouncing off the bottom here, and Nvidia can't seem to keep it up today either. Amazon, for some reasons, down 1%. Enphase is down 0.71. Ethereum's down a couple, 3,500. Trade Desk stuck at about 95. Well, that's a pretty good level to be stuck at. That's a pretty good number. Ooh, Vertiv went negative. Straight down since the open. Chipotle's still up. Who sells Chipotle? It can't be sold. It is impossible. It is not possible.
Woods. Coming up, Bill Gates is ready to go nuclear.
Of all the climate-related work I'm doing, I'd say the one that has the most bipartisan energy behind it is actually this nuclear work.
Why he's ready to put billions more into a next-generation power plant next. This is Bloomberg.
So which company is that? Let's see. Bill Gates. Let's see here. Let's see here. Terra Power, LLC, a startup founded by Gates, broke ground for its first commercial reactor. Also, it's a company he co-founded. Got it. Exploring cheaper reactors, expects to complete its new reactors in 2030. Terra Power, which has backing from the U.S. Department of Energy. Yeah. Terra Power. Wyoming. A nuclear innovation company. Ah, okay. Fancy graphics. Get some nuclear power out in a ranch somewhere in Wyoming. Ah, fancy. Ooh, Tesla's trying to move up. Terra Power is an American nuclear reactor design and development engineering company headquartered in Bellevue, Washington. Fast reactors, termed traveling wave reactors. Okay, new breeds of reactors. this company's been trying to do this for like 20 years. Wow. All right. Okie dokie. Okie dokie, artichoke. Let's listen in here.
In the VIX futures curve, where you see a bump in October, bearing in mind that VIX is always looking ahead 30 days, so mid-October VIX is looking at the election. We do see that bump. It's not there yet, but I do think that bump is going to get more pronounced as we get closer to the election, because I think the range of potential economic outcomes stemming from the election is quite wide.
Right. We'll be talking about that more in the months to come. Steve, it's great to have you in.
Thanks
for coming by.
Thank you.
Steve Sosnick. As we go to break, let's watch bonds today. As you know, Fed Speak is back in action. We will get some today.
NVIDIA really slowed down here. It's only up about 1/3% right now.
The yield's got a little bump as the Empire survey came in a little bit better than expected. We're back to 428. Stay with us.
Very interesting market today. Yeah. Okie dokie then. So let's see here. Coinbase is almost down a full 3% right now. Let's pop back in over here. So really some big moves here. Oh wow, look at NVIDIA. Go NVIDIA, go! Down! Dive! 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 Oh, what? What is happening? I gotta zoom out. That candlestick's moving down so fast. Holy schmokas. That's it. The top is in. Sell everything. Oh, boy. Well, that was wild. Ay, ay, ay. You know what else would be wild? Some more coffee. Ah, yes. Yes. This is what happens when you play too many video games with your 8-year-old. Last night, Jack did not want to go to sleep. It's like, Dad, just a little more, just a little more. And I'm like, but son, it's Father's Day. And he's like, exactly. So play games with me. And I'm like, okay, I'm convinced. Now I'm tired. There comes the red candle on Tesla. But Apple's trying to go up. Look at that. There's just the volatility here. There's insane movements to the up or downside. Bitcoin's not happy. Bitcoin just keeps going. And going and going. It's just trying to gap down. This is crazy. Holy schmokas. Ay, ay, ay. It's not like there's any news all of a sudden on NVIDIA. It's just, I think maybe people finally woke up. They're like, nah. Time to take attendees. Oh, wait, no, what is this? No, this is old. That's like 15. NVIDIA gets Supreme Court review on shareholder crypto suit. I don't know that that's really new moving anything here. Let's listen in here.
Possible that this could pick up, that it could catch on?
More Gates stuff.
I mean, the thing that you need to keep in mind is it's all about climate change, because nuclear is carbon-free power that runs around the clock. Wind and solar don't run around the clock. Hydropower does, but it's hard to find new places for it. Only nuclear can do that, but it is expensive and slow to build today. You know, in the future, in theory, once we get these things going, they should be able to be built faster and quicker, but right now it's sort of all new technology, new build, and everything that new is, you know, slow and time consuming.
Well, and what about the waste? Is there still that problem of where to put the spent, you know, uranium or whatever, or have they dealt with that?
Oh no, it's still there. Every nuclear power plant has old spent fuel rods sitting out back, and they're going to be there. But I think that's a...
They're going to be there for a while, huh?
Well, I mean, they're going to be there for a while, and it's deadly for thousands of years. But I look at it this way, like, everything is dangerous. If you live near a coal plant, you know, the emissions are bad. You know, you're likely to get asthma. Gas plant, you know, everything in the world is dangerous. Nuclear is also dangerous, but they take the waste issue very seriously. there's not that much of it.
Well, okay, so if not the waste being a problem, I grew up in the wake of 3 Mile Island, as did you. Of course. We all saw Fukushima rock the markets, and they're still recovering from that. Like, can that part of it be contained? Well, with new technology, right? This is what I'm wondering, because Bill Gates is kind of a preacher in terms of nuclear can be safe. Nuclear is clean. So is he right?
Yeah, there's definitely ways that you can design new plants that they are safer. Nothing in the world is 100% safe, even if you stay in your bed all day. But the new plants, they are safer. They have a lot more advanced designs, like the ones that, if you lose the electricity, the gravity will sort of keep water flowing to keep the fuel cooled and safe. So they're not as risky as some of the old school reactors that we saw in the 70s.
This new one doesn't even use water, right? It uses like molten salt.
Molten sodium, yeah. Well, it's got liquid sodium as the coolant instead of water, so that lets it get hotter, and that makes it more efficient. Plus, it has this storage tank of salt, so you can get extra power from it if you need to.
It's such a cool science, and I'm so glad that we have you covering it, Will. Thanks so much for coming on the program. Bloomberg's Will Wade talking to us about Bill Gates.
Will Wade. That's cool. That's like double first name here.
Sector price action that we're watching in the market this morning, just 22 minutes into the session. Let's get over to Bloomberg's Abigail Doolittle. Abby, what do you see?
Well, we're looking at another small decline for the S&P 500 right now, on pace for a second down day in a row. Somewhat broad-based from a sector standpoint: real estate, communication services, utilities, healthcare, materials, tech, and discretionary all lower. Real estate down the most. Yields are popping higher today, as you know. So that, of course, makes those stocks look less attractive given the real estate play plus the dividends. On the upside, energy, but up just a little bit, up 0.3%, and then 3 other sectors a little bit higher as well. Let's take a look at one sector that is underperforming, however, and that is biotech. The biotech index down for a second day in a row, the worst 2 days going back for about a month or so. And it doesn't seem to be anything so macro, but there's lots of news at a micro level, including Takeda's epilepsy drug, their phase 3 trial didn't meet the primary endpoint, and that stock and some other stocks down significantly, weighing on that biotech sector, Matt.
All right, Abigail looking at the sectors for us. Coming up, Fed officials return to the public speaking circuit. Did they ever leave? The market moving events you need to be watching. That's next in our trading diary. This is Bloomberg.
Somebody's like, buy salt. Yes. Yes, if they are going to melt salt for nuclear power, please buy all the salt.
The stake action raising its full-year comp guidance ahead of its recent launch, due in part to an anticipated tailwind from offering stake. And this will likely again appeal to dinner-time customers, which is something that Kava actually managed to grow significantly during the pandemic and has been a leader on. Dutch Bros, another great example. The chain offers specialty coffees and introduced protein-infused coffee as a limited-time offer, but CEO Christine Barone said younger consumers are drinking it, and some customers now use it as a meal replacement. So they decided to add it as a permanent fixture to the menu. Reminder, Bros had 10% same-store sales growth this quarter, its strongest quarter in 3 years. Now, for the story, I spoke with Manitree Investments. That's a private equity firm investing in the health and nutrition space. The consumer desire for more and more protein is stronger than it's ever been, according to their investment lead, Steve Young. Consumers are willing to spend a bit more on something that may be perceived to be healthier or something that achieves a desired goal for them, like adding more fat or protein to their diet. So very interesting trend here, guys. And Sweetgreen and Kava, we should note, both up more than 100% year to date, which is quite impressive. Back over to you.
It kind of reminds me, Kate, of the grief that Chipotle has gotten for the servers that are giving you food. If you whip out your phone, they feel under pressure to make the serving size a little bit larger.
Yeah, definitely. And Brian Nickel has said that's a little...
Oh, that's got to be like the most annoying trend ever. I feel bad for the workers.
And in fact, Chipotle says it has not changed its serving sizes. So again, this gets back to that trend where people are spending a bit more cautiously, perhaps. They want more from restaurants in this environment, and everyone's trying to keep everyone else happy, right?
Is it a fad, do you think, that just people protein now, or this is a long-term story?
I think it's a long-term story because remember, health kind of comes and goes, and Chipotle was a leader on this one. Remember, a few years ago, made the Whole30 partnership quite popular, and that also helped grow both their lunch and their dinner business because people wanted something that was healthier and kind of adhered to some of these different dietary shifts and changes that they were making. So I think that this is here to stay. It takes different formats, as time kind of evolves, but I don't think this one's going away anytime soon, guys.
Kate, appreciate it. Hopefully we can catch up again and talk about McDonald's AI, another interesting story on your beat. That's our Kate Rogers.
Oh, yeah, we touched on that a little earlier.
Megatech and AI with Wedbush's Dan Ives raising his target on Microsoft as the week opens a bit soft. S&P's down 9. Don't go away.
Yeah, it's a bizarro kind of day. You had the Qs briefly positive for a moment. You're getting stuck in the mud a little bit. You're at negative 10 basis points now. Tesla's consolidating now amongst this like 160-ish to the upside percent range. BTC is slowly bleeding here. Slow bleed on BTC, and that's leading to a bleed on Coinbase. Nvidia's going green again. Yeah, it just went green again. So it fell and hit a floor there. Now it's coming right back, and that's leading the Qs to try to go green again. Then you've got what else here? Apple, Nvidia, Qs, Amazon, Enphase. Ethereum just broke 35 to the downside. Trade desk down about 0.5%. Like nothing particularly screaming in one direction. Vertiv's down 4%. That's a good chunk there. AMD down about 2.7. Huh, interesting. All right, let's go back over here. Let's do this. All right, listening. Oh, nope. Okay, fine then. Fine. Yeah, Tesla's just consolidating. Boring. Nvidia's back up to 25-ish basis points. And yeah, that's leading the Qs to go green. Okay, very well. Well, what time Fed speakers? Oh man, the Fed speaker calendar is kind of boring. I feel like they all say the same stuff over and over again. But let's see, today's the 17th. Who speaks today? Lisa Cook at 9 p.m. Wow, p.m. Okay. Oh. Look at Bitcoin. What's going on over here? Just like gapping down. Yeah. That's exactly what it's doing. Not very enthusiastic. That's driving, well, the Qs are still pushing up. Yeah, well, because Nvidia's holding up. That's the only thing that drives the Qs or S&P 500 up. It's kind of remarkable. Alrighty then. Let's see, what else? I don't know. I don't know that there is much else. Let's see what the squawkers have to say. Qs keep going. There's no real particular news. Let's listen in here for
another hour of Squawk on the Street. I'm Sarah Eisen here with Carl Quintanilla. David Faber off today. We are live from Post 9 of the New York Stock Exchange. Take a look at stocks. We're down just 0.1% in the S&P. Just in the last half hour of trading, we opened lower, came back, and now a number of sectors have turned green, along with information technology, which is, of course, at the top where it has been lately. We've got consumer staples, industrials, energy, and consumer discretionary all in positive territory. The NASDAQ 100 also has gone positive this morning. Again, it's been a huge outperformer for the quarter, up 8%, for the year, up 17%. And that strength, thanks in part to strength in the chip stocks. Today, it's Broadcom, which is continuing its rally off last week. Nvidia's up again, Apple's up again, Tesla doing well, Micron, Autodesk, we'll talk about in a moment as well. Take a look at treasuries. The trend has been lower treasury yields, and it's reversing a bit today, but we're still sharply off those highs that we got just a few weeks ago, which when the 10-year was 4.6, we're now below 4.3, the 2-year yield 4.74. 30 minutes here into trading. Here are some movers we are watching this hour. More bullish calls this morning when it comes to mega cap tech. Microsoft, Apple, and Nvidia continue to battle it out for the title of the world's most valuable company. More on the key names to watch here in just a moment. Shares of Dell Technologies rallying. The stock reiterated overweight at Morgan Stanley, $155 price target. Shares are now up more than 80% so far this year. And we've got a big interview coming up in the next hour with CEO Michael Dell. That is on Money Movers.
Ooh.
Today, activist investor Starboard Value has taken a stake in the name. Much more on that story, what the investor wants and how the company is responding in just a little bit, with the stock up almost 4%. Carl, it's not going to compare to last week when we had CPI and the Fed, but there are some important data points this week. Retail sales is going to be a highlight. It's out tomorrow. Industrial production as well. The markets closed on Wednesday here in the U.S. for Juneteenth, but we will get British inflation. Jobless claims on Thursday takes on even more importance after we got an elevated read on the number of American filing for unemployment claims last week. See if that trend continues, and then some home sales data. What else we'll be watching is central banks around the world. Just because the Fed's out of the way, we also have Australia, Bank of England. We have minutes from the Bank of Japan. We have a few other central banks in focus as well. And the reason I bring this up is because we've been following the inflation numbers so carefully in the U.S., but it really has been a global story. The elevated inflation that we got in the last few years, and now the disinflation that we are seeing. There's a great chart that we made from Bank of America that shows the global CPI, which has dipped below 3% from last year. There's the spike up, right, coming out of COVID. We certainly got high readings here in the U.S., as high as 9%, and it has come down. We're not quite as low as the median global number yet, below 3%, but we could be getting there. And so that phenomenon, I think, is worth watching as we wonder what global central banks are going to do.
In the meantime, I'm thinking of what Powell said in the presser last week about how we look at inflation versus, say, our trade partners. RSM with a nice chart over the weekend looking at harmonized CPI PCE. And the argument is, if we measured inflation the way our trade partners do, we'd be looking at a 195 handle right now. And the Fed would be actively talking about cuts.
Owner's equivalent rent is really overweighted shelter as a component in our CPI report. It's why the Fed pays maybe more attention to PCE, which it doesn't. It's not as weighted. But that, that could be one explanation for why we're seeing lower inflation. And, there's a lot of talk about divergences of central banks. And sure, they're not all moving at the same exact speed, but they are all moving toward lowering interest rates instead of tightening interest rates where they were. The other chart that I pulled out showed the turn has happened. So this is percent of central bank tightening. Ran up, right? Everybody was hiking, the Fed, the ECB, the Bank of England, Canada. Guess what? The easing cycle has begun. So even if it's happening at different speeds, it's still happening. Now there's a debate about June and July and August and September, but the debates are all about when the central banks will ease. And again, it's an important underpinning because markets are global, liquidity is global, and when there's easing in multiple places, that does potentially offer a stimulative effect for global markets. Now, Taylor Swift coming to the UK in August might set them back, according to Cowen. Or maybe
yes, Taylor Swift will save your jobs market, United Kingdom. Fear not. Okay, that's where I gotta push the button and go to the course member live stream. Let's make some more coffee. Go to the course member live stream. That was fun. Not really. It's not too many catalysts here. But anyway, let's push the button. Even though I'm a licensed financial advisor, real estate broker, and becoming a stockbroker, this video is neither personalized financial advice nor real estate advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show should not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purpose of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services which we may benefit from. I personally operate and actively manage the ETF and hold long positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuers other than HouseHack, nor am I presently acting as a market maker. Yep. There you have it. Coffee time. And we'll see you in the next one. Thanks so much for being here.